Stewart, let's just start off just with kind of the overall price picture in oil, because I felt like a year ago, I think we were above $100 a barrel on WTI. Even just 3 months ago, we were above 80, but we seem to kind of be stuck around that $70 a barrel range for the last couple of months. And I'm wondering if you see any potential for a breakout either to the upside or to the downside.
Good afternoon, Romaine. Thanks for having me. So you're right. Last year at this time, the world was concerned about the number of barrels that might be leaving the market, either because Russia would take some off the market voluntarily or because of war, war issues. A lot of those fears did not come to pass, and so the frothiness we saw last year with oil above $120 a barrel settled back down. And then you fast forward to this year, and I think really the story has really been more on the demand side and concerns about where incremental global oil demand growth is going to be coming from. So if you pose it as, if we're more likely to get a breakout to the upside or to the downside, I would say near term, I'm more concerned about downside risk.
So what does that sort of mean, though, for a lot of the oil and gas stocks? I know there's sort of this weird kind of not quite symbiosis, if you will, in the trajectory of oil prices and the trajectory of stock prices themselves here. What's the relationship right now?
Right. So the big picture is, if you're an oil producer, you'd probably be very happy with $80 a barrel crude. Your earnings power is going to be, quite high at those levels. It's not going to bring you back to record highs that you got last year, but certainly much better than if you had crude at 50, 60s. And most shale projects are going to, or actually all shale projects are going to work at $8 a barrel oil, and a lot of international projects are going to work as well. The fear, I think, is, can demand fall apart faster than OPEC can adjust? And you've seen some of the OPEC participants, notably Saudi Arabia and Russia, try to be pretty agile and have announced cuts. And so if you look ahead to the second half of this year, they're calling for overall cartel cuts of around 5 million barrels a day collectively. It's around 5% of the global market. And yet oil still can't sustain itself above $72, $73 a barrel, which I think gives you some indication that there's real fear out there about potential recession and what that might do to global demand.
And absolutely. I mean, we talk about an energy sector that, of course, was the best performing sector, I think, last year, or at least for a good portion of 2022, and now one of the worst performing sectors this year. Is there sort of a way that you sort of go through that basket of oil and gas stocks and try to find and separate the winners from the losers? Or is this one of these sort of rising tides lifts all boats, if you will?
Right. Good question. So I think that it is possible to be nimble within energy. So on the producer side, I would tend to favor names that have relatively lower debt burdens, and I would say are fairly conservatively managed. So take a name like EOG Resources with a net debt to capital ratio in the mid-single digits, looks quite attractive. And then you can look at other areas of the value chain, like midstream, for example. Really doesn't depend on high oil prices to prosper. All you really need is oil prices high enough that the producers are not going to be doing anything differently with their capital plans. And so a name like a Targa Resources, ticker TRGP, we have a strong buyer, 5 stars opinion there. Enterprise Products Partners, ticker EPD, we have a 4 stars or buy opinion. Both of these are midstream firms that offer a lot in the way of exposure to natural gas liquids, which is like a building block in chemicals. Ties into the energy export play because of their proximity to the U.S. Gulf Coast. And then if you think about natural gas prices, obviously kind of cresting along the bottom more or less this year compared to really strong last year, I don't think that these prices are likely to persist. And so a name like Chevron, which has greater natural gas exposure than an Exxon does, we like Chevron, and we have a buy opinion on Chevron as well.